Hello, thank you for joining me. Clifford Bennett, Chief Economist, ACY Securities. It's been a very interesting and intriguing week this week, with the Federal Reserve coming out and saying its own forecast or estimates within its own board suggest that it's going to hike rates 3 times next year. Here at ACY, myself personally, I'm pretty confident the Fed will be raising rates 5 times next year because their own forecast isn't quite capturing where the world will be, where the United States will be in terms of inflation being ongoing, high, persistently very high and worrying. That is the outlook for inflation. That is why the Fed will be raising interest rates rather aggressively, even more than it currently expects. Now, the market initially, and I did say in the couple of days before the Fed meeting that the whole world was ready to buy post the announcement, no matter what it was, and that's definitely what we saw. We saw one of the biggest rallies, one-day rallies you can imagine. The market was on its highs, closing in New York. Everything looked extremely bullish. I said Asia would probably be buying, but this is a rally to sell, and it most certainly was, because one day massively up, the next day massively down, and there are some technical price action points there suggesting that there's some kind of island reversal happening, and that could really add power to a downside move from the current range. Now, the thing about the current range is that we could be here for several days, maybe even a couple of weeks in this sideways, huge swinging, chopping market. It has been a characteristic of the post-2018 period where we saw markets change character rather emphatically, making it difficult for all of those of us who had lots and lots of experience, which no longer seemed all that appropriate post-2018 as the nature of price action, with social media and a far more diverse participation in markets generally than we'd ever seen before in history. So that was the big change that happened around 2018. Very clear changes in price action. Also a lot of computer program buying and selling, various algorithms, all those sorts of things just came to a head, and the nature of price action changed long term from that point in time. And some of us who are a little bit more experienced, we had trouble adjusting to that. But if you were new to markets, it was easier to pick up. So well done to a whole lot of people out there who've done very well in the markets over the last few years. Right now in markets though, I've been warning for some time that we will see an eventual downturn. I've been picking the top in the Australian market since 4 months ago. As I just said on another discussion piece a short while ago, that's 4 months the Australian stock market has been going sideways to down. But still sentiment remains excited, despite the fact that it's been a bearish market pretty much for 4 months, a third of a year, which is interesting. So if the US market, as I think, begins to fold back down in on itself, as I believe it's currently doing, then that's going to add a lot of fuel to the downside for the Australian market as well. So I just think be aware that a slip sliding away market is a very real risk and possibility at current levels. In the currency market, it's very much a US dollar story at the moment. I think a lot of people are expecting a US dollar top, but again, we're seeing renewed buying. Even in sterling, after the Bank of England raised interest rates, we're seeing that really the peak in that sterling rally has already possibly been seen within just a few hours as Omicron spreads around the world and there is supply chain disruption. We are going to see continued safe haven flights, if you like, towards the US dollar. Now, I think probably the euro and the yuan are equally secure reserve currencies now, as I spoke about at APEC in 2012 in Russia, saying that we were going to have 3 reserve currencies in the world: the yuan, the euro, and the US dollar. And of course, in 4th place is probably the Russian ruble, but that's for a specific region of the world. But the 3 major reserve currencies are going to be euro, US dollar, and the yuan. But that's the reality I think we're headed towards. But at the moment, most corporations in the world, if they get a little scared, most wealthy individuals in the world, if they get a little bit scared about what's happening in the world generally, then they're still going to go to the US dollar. So that upward pressure in the US dollar, particularly as the Fed begins to hike rates and do so ever more aggressively. We've already had lots of other central banks in the world hiking rates, but they haven't been one of those major three. So we're going to see interest rate hikes. The ECB reduced its bond buying yesterday while the BoE was hiking interest rates. If you look at a 25-year chart of interest rates anywhere in the world at the moment, if you look at the Bank of England, if you look at the US Federal Reserve, if you look at the RBA's long-term interest rate charts, you can tell that these current rate hikes are immaterial to what's really going on in the big macro picture. In other words, what I'm saying is these are baby steps on what are going to become huge first hurdle leaping and then maybe even high jump leaping interest rate hikes going forward. And the slower central banks are to begin raising rates, and the RBA is probably, the Reserve Bank of Australia is probably going to be the slowest of all of those. The slower you are, the more tremendous the eventual rate hikes are going to be. This is why I'm so passionate about it. This is why I'm talking about it all the time. It's because being late to the party of heading off inflation, which is here to stay because it's about freedom of pricing, being late to the party means horrific price hikes, interest rate hikes further down the track. So it's important to get the message out there. Wake up, Reserve Bank of Australia. Try to at least look out the side windows as well as the rear vision mirror. At least get to the side windows to see what's going on in the world. It'd be great if you were looking through the windscreen like other central banks in the world, but that's probably too much to hope for. But if we could get you even looking out the back passenger windows, that'd be a massive improvement, RBA. Can we please get you doing that? Because you shouldn't have any bond buying. You shouldn't be talking about reducing it. You should just stop it. And we should already be at 0.5% interest rates, headed for 1.5 next year. Otherwise, inflation is out of the bag. It's going to tear away at our economy. It's going to tear away at the spending power of Australian workers, and it's going to end in even greater tears than otherwise would need to be the case. In markets, still think, sell stocks, particularly sell Australian stocks, sell tech stocks. I think the tech bubble might be bursting to some degree, or at least having a major correction. I think buy gold, buy gold, buy gold, buy silver too. As Nathan Bray mentioned on our discussion chat yesterday. If you haven't seen that, make sure you do. The other thing, I just like selling the Australian dollar. You know, my forecast at 77.45 on AusBiz was 70 cents. Everyone was bullish then, by the way. You know, if you see nothing but bearish comments around now, they were all bullish at 77.45. We said 70 cents, and that's where we got to. And then I upgraded that forecast to 65 cents for 2022, risk 58 cents 2023, and that I think is still something we all need to be very much aware of. I'm not bullish Australia for the loss of immigration, the loss of global travel, the global trade disruption, deteriorating relationship with China and some other nations as well, not just China. So that's all a little bit of a worry for this small trading nation down at the bottom of the world here. Thank you very much for your time. Good luck in the markets. Clifford Bennett, Chief Economist, ACY Securities.